All right, we'll call to order our meeting of the Oklahoma City Post-Employment Benefits Trust for November the 13th, 2017. The first item of business is approval of the minutes from the October 9th meeting. All in favor? Aye. Any opposed? Next item is presentation of the investment performance review for the period ending September 30th, 2017. Doug Anderson is here from ANCO.
Good morning, everyone. Bear with me today. We've got quite a lot to talk about, but no changes, and it's all good news. If you would open the bound September 30 quarterly report, I will not be going through the market environment page by page. Just suffice it to say, when we go to page 2, looking at performance in the upper right-hand side of the table there, how strong performance has been, and you've actually seen a bit of a turn where non-U.S. equities have started to outperform U.S. equities. And as we go down for the one-year return there, you can see just how strong returns have been. Non-U.S. equities up nearly 20%, if not more than 20%. Domestic equities up in the very high teens, and bonds are very modest performers given that interest rates are quite low and possibly headed higher right now, but too soon to tell. Although the latest handicap is that the Federal Reserve will raise short-term rates another time in December, and it's really hard to believe that we're this close to December already. Page 3 is an important page to understand how portfolios have performed this year. If you look on the top chart there, that is the quarterly performance for the Russell style indexes. And what we do is we divide it up into Russell 3000, which is predominantly all the stocks on the U.S. stock exchange, and we divide it into the core index, which is encompassing of growth and value, and that's up 4.6% during the quarter. But if you look at the growth, is outperforming by almost 2% there. And as you look down for the 1,000, which are just very large companies, mid-cap, which is mid-sized companies, and small caps, you can see that growth has outperformed value across the board, not only for the quarter, but also for the year, and for the latest month, that's even extended itself even further. So growth companies performing better than value, and a lot of folks say when financials underperform and energy underperforms, then you're going to see growth naturally take the lead, but that's not always been the case, although sector performance has been very influential. Energy, if you see on the following page, page 4, seeing how performance is for the Russell 1000, and the dark red column there shows for the quarter, and then the pink column shows for the trailing 1 year. And you'll see that financials have outperformed, but that doesn't mean that that values outperform. So it's slightly unusual. You look at other strong parts of the marketplace, info technology for the year, materials, all of these are saying that we've got a cyclical strength in the economy. And it's not just in the United States, but Europe has emerged with some strength this year where we haven't seen it before. I think that's enough on the market environment for the equities, but on page 8 you can see fixed income, how that market has performed. And that is important to keep an eye on that. For the quarter, you can see we had positive returns for fixed income, and all of this Opebt soup or AAA rated bonds were up 0.6%. BAA, which is the lowest investment grade, is up 1.6%. So that's a pretty strong quarter for BAA bonds. High yield fixed was up 2%. And if you go down to the bottom table here, you can see high yield outperformed by a very significant margin, 8.9%, whereas AAA bonds are down 0.7%. So risk-taking was definitely rewarded over the past year, and in some cases, buying the least aggressive or the least credit risky bonds punished you, whereas you see that the AAA bonds performed the worst. U.S. Treasuries were down 1.7% over the year, and TIPS, which are Treasury inflation-protected securities, were down 0.7%. So risk-taking was rewarded in the bond market over the past year. And then on page 9, you can see the yield curve on the bottom right-hand side. All of those lines depict, at different points in time, what the yield curve is. And the yield curve just tells us what the price of money is for various terms. We start with the 1 month here and go all the way out to the 30-year Treasury. And these are just Treasury bonds, so there's no credit risk involved here. And you'll see that the blue line is as of 12/31 of 2016. And then we have quarter by quarter all the way up to 9/30. And what you will notice is that as of 12/31 of last year, short-term interest rates have risen, whereas long-term interest rates have actually gone down a slight bit over the most recent quarter. So that's called a flattening of the yield curve. And the thing that we really want to be conscious of is if we see an inversion of the yield curve, meaning if the short end goes up higher than the long end of the curve, because that inhibits capital formation. And it is one of the best predictors of recession that's out there. We're not close to it right now, but taking a look at the 10 to the 30-year difference, or 10 to 30-year spread, it's pretty narrow right now. So taking that additional 20 years of risk on duration or maturity doesn't pay that much. So you're seeing that in a lot of bond portfolios, but then you're not seeing it in other ones. Page 10, my favorite number, 12.6%. It's a good one. Let's be thankful. I mean, we're coming up on Thanksgiving here, and I think that we're all pleasantly surprised by how good the returns have been. And I was doing it for a couple of other clients, but going back until the great financial crisis and taking a look at what their trailing year returns were. We were so young and so new here that I didn't really think that had a lot of benefit to bring that to you. But just remember, in the great financial crisis, March 6th, 2009 was the bottom. And if you looked back at equity returns for the trailing year at that time, you're looking down 35-40%. Fixed income was not a huge help either. So you saw lots of balanced portfolios, stock and bond portfolios like we have here, down in the mid to high 20s even over a one-year period of time. So it doesn't always have to be this way. We've been very, very fortunate. Our managers have done well. Looking on page 12, again, you can see here, we did not have that period of time, but we were definitely, I would say, conscious of it when we first structured and first managed the portfolio, because we were risk averse. And I think that was a smart thing to do. We've had this talk many, many times, but it's important to remember that when we first started investing in this portfolio, we were fresh off of the financial crisis, and at that time it was not clear that we were through it. So in the interest of preserving capital and preserving the principal that had been entrusted to the Opebt Trust, we did take less risk than some other funds that had been in existence longer than that. You'll see page 13 shows us this very, very clearly, where the allocation to fixed income was much higher until we got into 2011, 2010, 2011, and that first year out of the great financial crisis saw equity prices go up pretty fast. And we should also remember that if we're ever facing that type of situation again. Looking at page 14, our allocation now, 60% equities, domestic equities, 17.5% core fixed income, 10% international equity. So that gives us a rough total of 70% in equities. And that is somewhat aggressive, but again, this is a fund that is built for almost perpetuity, right? It is built to invest through cycles, through the good days and through the bad days, and we have ways to cushion some of the bad days and then take advantage of it also. Active duration fixed income at 8.5%, high yield fixed income at 3%, and cash at 0.1%. And the managers are listed on page 15. Largest allocation is the Vanguard 500 index. I was looking at a story last night. Vanguard and BlackRock, the two biggest passive managers in the world, are taking in on average $3 billion a day, a trading day, in new fund flows to their passive portfolios. So that is a big change that we've seen in the markets. And I think that we've been able to take advantage of that by having this exposure. You'll see our next portfolios are going to be the actively managed ones until we go to the Vanguard Mid-Cap Index. Near the bottom, then our high yield and our Kavanaugh Hill cash kept very low levels. Next page shows us the contribution and distribution for the 1 quarter. You can see there was a contribution of $2 million. You can see where those funds were allocated. To $700,000 to the Vanguard 500 index, almost $100,000 to Hotchkiss and Wiley, $200,000 to the Vanguard Mid-Cap, $170,000 to Stevens, none to Causeway, very close to target there, and you see the fixed income portfolios were also got some funds. Now, it's interesting as you follow across the top line, you see $2 million contribution, $191,000 in income, and depreciation of $1.6 million during the quarter. And most of that came from the equity portfolio. And the largest contributor was your largest fund, which is the Vanguard Index. Now, the next page shows the total fund and all of our investments return as of 9/30 going back. So for the quarter, the fund was up 3.73%. For the 1 year, it was up 12.6%. For the 3 years, 6.15. For the 5 years, 7.23. And for the 7 years, 7.10. Now, last time I was here to meet, we have been discussing the fact that our recent returns are much better on a relative basis. The parentheses, figures inside the parentheses tell us how the fund and the individual investments fared versus their peers. And you'll see that the last quarter and the last 1 year look pretty good compared to the 3, 5, and 7 year figures. And of course, a lot of that has to do with our allocation early on. But I was asked to take a look at how we would have done had we been invested as we are today over those 3, 5, and 7 year periods. And there's a handout in front of you. It says performance comparison of portfolio structures as of the third quarter 2017. And what I did on this exercise was took a look at the asset allocation of the portfolio and compared it with the current portfolio. So on the top table here on page 2 is identical. So it shows the current portfolio versus the actual portfolio. And then we have the target portfolio, and that's mostly different on the fixed income side because we've been sort of reducing risk and increasing our hedge in the Hoisington portfolio there. If you look at the bottom table, this is hypothetical versus actual performance of the actual portfolio, which you can see matches page 17 of the quarterly report and shows you the returns over time. Now, the current portfolio shows you, had we been allocated exactly as we were on 9/30, what the long-term returns and what those ranks would have been. So remember, we've done a lot of work on the portfolio, changing managers in and out. But had we had the current allocation going back for 3 years, 5 years, and 10 years, you can see how much returns would have improved. So the efforts that we've made recently would have shown long-term benefits. And as much as I advocate being patient investors, sometimes changes are necessary. Now, you can see that the target portfolio is slightly different there. And actually, our current portfolio is outperforming our target. But I don't want to say that we need to change our target to our current because we do have some flexibility within the policy to reduce risk when we feel it's a good time to do that. So this is not quite a proof statement, but this is an exercise saying that the changes that we have made have been positive, and that when we look over the last 10 years, returns could have been better, and we need to be cognizant of that going forward. So does that answer the questions that you had?
Yes, it does. And I think it helps just when you look back and you see, if you just look over the period, like inception to date, and you look at where we compare to peers, that you would see that it kind of goes back to the one slide you have at the beginning, back on page 13, that shows where we were previously, with how much we had invested in fixed income and why really we kind of missed out on some of the opportunity in the market coming out of the downturn. Because we were more conservative at the time because we had lower value. So, so I just think it helps to put that into context and helps us to understand the direction that we're moving.
I would add to that is that we've made management changes over that time. I mean, in full transparency, we have made management changes, and I think that plays into it as well. But if we look at page 2, we like to call this hindsight capital management. Doesn't really apply, but it does teach us some lessons. We can learn from it.
Question, just for point of clarification, I probably missed it. The actual versus the current?
Yes.
What's the difference between that?
So the actual is the returns as they were actually returned. And I know that's a little bit confusing, actual versus current. And the current tells you, had we had the same manager, same allocation as we do today, and we hypothetically simulate that going back, that's what we would have done.
Okay, got it. Thank you.
And one of the things about that is that it's the simulator that we use rebalances every quarter. So it keeps asset allocation in line over time that way. So it's an interesting tool. I do like to take a look back at that. Looking at page 17, so the return for the past year, 12.6%. That's quite good. If we look at the Loomis Sales bond portfolio over the last year, for that, you can see the row there, 6.22 in the first percentile. Its index was, it beat its index by almost 6.25%, which is phenomenal in the bond world. The double line bond was up 1.81. It's a little bit more cautious on the credit perspective, but it was in the 8th percentile. Our high yield portfolio was in the 5th percentile. Hoisington, 8.92% loss, and again, this is our hedging portfolio. I am not alarmed by this figure. If we look for the last, the quarter, 0.37. If we look on the year to date, they might be your best bond performer. And if we look over the last 3 years, 5.04 in the 3rd percentile. Remember, when everything else is up, this portfolio is highly likely to be down. And when everything else is down, this portfolio is highly likely to be up. And that's one of the reasons that it has an 8.5% allocation now, which is slightly more than target. And we're comfortable with that. We've been in an expansive, positive bull market for 9 years. I think this is not the time to pull back on your risk hedge. Looking down the list, the 500 index is tracking its benchmark. The mid-cap index is tracking its benchmark. Hotchkiss & Wiley is performing better. You can see for the quarter is up 3.58%, for the year up 15.69%. And that's a tough market to outperform in. Stevens is putting up good absolute return numbers. And again, this late in a market cycle, I am very much opposed to adding a riskier small cap growth option. This is a low risk small cap growth option, and I'm fully aware of that. And the returns are not keeping up with some of the higher volatility, higher momentum names, and I'm perfectly comfortable with that. You can see that our Causeway International Value portfolio is up 21.51% for the trailing 1 year, which beat its benchmark. And again, all of these are net of fees. So we're okay with that. And for the quarter, it's 6.88% versus 5.47. Causeway is a very interesting firm and continue to really admire their work a lot. So I'm not going to go through the individual pages, but the portfolios are performing well. The combination looks good. I think that if we were to take a step back to, I'm going to go ask you to make a big jump here. Going to page 39. It's a correlation matrix of the returns of the investments of the trust. You can see that the rows and the columns tell us where they intersect one another, how the individual assets perform versus one another. So I'm going to call attention to column D, which is the Wasatch Hoisington U.S. Treasury Fund. Remember, this is our bond portfolio that right now it's all long-term Treasury bonds. And you look at its correlation going down, column D, versus virtually all of the other investments in the trust, and it has a negative correlation. So this is what they call in the business a hedge. It's a very low-cost hedge, though. It doesn't cost 2% of your allocation and 20% of your returns, and it is extremely effective. If we look at the other investments across the bottom row, say the Causeway International Equity, you can see its returns have somewhat low correlation with our domestic assets, and that's how we want it. What we have seen in the markets this year is European equities do well, even despite Brexit, the hangover from that. But Europe right now appears to be where the U.S. was economically growth-wise a number of years ago. What we are seeing right now in the economy is a lot of central bank experimentation, but what we're also seeing is a fairly good period of economic growth throughout the world. On the next page, you see page 40 is our manager status report. I recommend no changes for this. We're not overly concerned with Stevens, but we are cognizant of the fact that their performance is not quite where we would like it to be. Page 41 is the fee summary. So we have the expense ratio of the individual investments, we have the category average, and then we have the difference, which is just the one subtracted from the other. Green means good, and then we have the average savings from each fund. Then at the bottom, we have total management fees, and this is an estimate, but we estimate that the total expense ratio is 46 basis points based on how much we have allocated to each. If we were in the category average, it would be 0.78, so we're saving 31 basis points on average, which is $116,000. So that's per year $116,000 in savings versus the average. And I think that there is absolutely no give up in quality with the funds that we're investing in. Page 42, the allocation versus target, and you can see on the bottom half of the table, given that we did have a $2 million contribution, that the bottom half of the table are the equity investments, and they are very, very close to their target levels there. You can see on the top half of the table, the fixed income, that we are slightly different from our target here because we have more in the risk-reducing asset, which is Hoisington, and less in our core bond portfolios. Nonetheless, each of those are $4 million, rough numbers, between those three. And I've found that to be a very effective combination, both in good times and in not so good times. So I do like that allocation. And on the following pages, on 43 and 44, Mr. Chairman, you asked to see longer-term results for our investments, even longer than we have had them within the trust, and on these pages they are shown. So for the 15 years, Loomis Sales is almost doubled, has doubled its benchmark, the bond fund. Double line's not been around that long. Loomis Sales High Yield is slightly below its benchmark. That's a very tough benchmark. If you look at Hoisington, 6.7 versus 4.23. The Vanguard Index, 9.91 annualized. The Vanguard Mid-Cap Index tracking its benchmark. Hotchkiss & Wiley, 1252 versus 1220. Stevens, not been around that long. And Causeway, 942 versus 826. That 10-year figure is about to change, knock on wood. If you look at the 10-year return, we're about to drop off the great financial crisis. Quarter by quarter, if we had a positive quarter for every negative quarter, and especially the third quarter of 2008 will be a big one when that falls off. That will be a significant increase in returns for the trailing 10-year period. Any questions about the quarterly report?
All right.
The agenda says that I have the monthly as well.
Yep.
Okay.
So we have monthly next on the report for the period ended October 31st.
That is correct.
Yep.
Market environment on page, or the first page there, you can see a market update. Russell 1000 was up 2.29. That brings the year-to-date up to 16.78. The Russell 2000, this is interesting that large companies are outperforming small companies by almost 6 or 5% on the year-to-date period. And then international equities up 23.4%. So the rally continued. U.S. fixed income up 0.6 and non-U.S. fixed income down 0.75 during the month. And you can see on the sector performance there on a month-to-date period that we had small companies. Energy is the one that continues to stick, unfortunately, for where we are. It is the one that continues to be the most subject to negative investor sentiment, no matter if oil prices are going up, as we have seen them recently, or turmoil in the Middle East, which seems to be increasing almost on a daily basis. Oil prices have remained muted, and energy company performance has remained fairly poor so far. Looking at the total fund composite, we're getting very close to $50 million at the total fund, which is that will be a great milestone. For the trailing 1 year, we're even better than we were on September 30th, 16.64% rate of return, which is fantastic. Looking down the list, similar performance as we saw in September for the trailing year period. Hoisington, again, they're the standout. They were flat for the month. For the quarter, they're up 159 though, as the long end of the yield curve, remember, is flattening right now. The Vanguard 500, 23.47, Vanguard Midcap, 20.54, Hotchkiss, 1963, See a slight uptick in the Stevens portfolio, but again, low-risk growth. It's not performing well. I have several other managers that I look at in this area, and they're all performing about the same. Looking at the Causeway International, 25.52 for the year, which marks it as the top performer, which I think last year we'd be a little bit surprised if I came here and predicted for the next year that that's going to be the best performer, which is why I don't do that. So that concludes the monthly report. More good news, and again, knocking on wood, but it is inevitable that I will come back and have a return with or reports that have negative results on them. And we should not project this into the future, although that is our innate human tendency to do so. I do look a lot at behavioral psychology and behavioral investing and economics to try to understand where we go wrong, and that's one of the big ones, just taking what we have today, or the recent past, and projecting it indefinitely into the future. One day we'll be glad to have bonds in the portfolio, and I can say that without any doubt. Just won't say when.
Current results do not indicate future performance.
That's right. It kind of makes you feel like you ought to go ahead and pull back now, just given the performance that we've seen over the last several months. So
but it really is hard to. I mean, it's very difficult to. With bond yields as low as they are, I mean, you've heard the acronym TINA, there is no alternative. And when you have all the central banks around the world lining up to encourage us to put money in equities, and they have the firepower to make it work, it's hard not to. Mm-hmm. It's really hard not to. But as far as taking profits, I think that's what we should concentrate on.
All right, thank you, Doug. Are there any questions? So I'd take a motion to receive the investment report for the period ending October 31st, 2017. All in favor? Thank you, Doug.
Thank you, Mr. Chairman and trustees.
Next item, we don't have any items on asset allocation or fund manager changes. Item number 6 is adopting a resolution authorizing an agreement with United Healthcare of Oklahoma, and this is for our major medical HMO plan. And we have Gina's here. She could answer any questions if we have them, or Diana could help us too. If there aren't any questions, then we could take a motion. And second? All in favor? Any opposed? The next item is also a resolution of an agreement with United Healthcare of Oklahoma, and this is for the Medicare Advantage plan. All in favor? Any opposed? Item 8 is a resolution for an agreement for administrative services with Blue Cross and Blue Shield of Oklahoma, and that's for the administrative services on our indemnity plan for the retirees. All in favor? Any opposed? All right, motion passes. Next item is the acceptance of the interim financial statements for the 3 months ended September 30th, and Jake Siebenaller is here from Accounting Services. He was waiting for me to mess it up again.
It's all good. Good morning. Thank you. We just want to highlight a couple items in your quarterly report. So we're going to start on page 3 under the management's discussion and analysis. Want to highlight that our total trust net position at the end of the quarter was $51.3 million. This is an increase compared to the prior fiscal year's first quarter of $5.4 million. That fiscal year's net position at the time was $45.9 million. As a comparison to the same time frame during the prior fiscal year, contributions have remained pretty constant. Our investment income has decreased slightly at $1.8 million compared to the prior fiscal year, and our total deductions have remained constant also. The trust has gained in the current fiscal year $7.7 million in net position. I'm sorry. In the prior fiscal year, we had gained $7.7 million during the first quarter in comparison to the $5.4 of our current year. The next item we want to look at is under the deposits and investment section under your notes. So we're going to flip back to page 10, please.
I have a question before you move on. On the comparison for last fiscal year versus the current fiscal year.
Yes, ma'am.
What do you attribute to the the change, the 7.7 versus the 5.4?
The big thing we recognized during fiscal year 17 that attributed to our increase is that we switched over from our custody banks from BOK to BOK. So our initial cost was recognized as our market value last year, so that increased our cost over the prior fiscal year. So we recognize a big net investment increase, basically, in our change from cost to market. So going to page 10, please. On this one, I want to draw attention to the money market account. Currently, we're showing a balance of $27,000 compared to the prior fiscal year of $2.8 million, and this money is basically used to pay for our current claims. The big decrease on this was the $2 million contribution that was made in the first quarter of FY18, is why the decrease is down. So, do you have any other questions on this report?
Are there any questions? Thank you, Jake.
The only other information we got, we're currently finishing up the FY17 audit. We anticipate that in the next probably week that should be released to you guys with, so far everything's come back good and clean, so we should be good to go from there.
Good.
Thank you.
Thank you. So I would take a motion to accept the interim financial statements for the period ended September 30, 2017. All in favor? Next item is the schedule of regular meetings. And in that, you'll see that we had discussed last time the possibility of moving to a quarterly meeting. We've had several meetings that either we won't have enough items on or have had issue with a quorum, that we've canceled meetings periodically. And when we looked back, it looked like if we would do quarterly meetings that we would still be able to capture everything we needed to. And the Treasurer's Office, they looked through to make sure that we scheduled these meetings so that it would come on periods where Doug would be here anyway, so that we'd hit the periods of the quarterly reports. So you can see that we've got them at February 12th, May 14th, August 13th, and November 19th of next year. The other issue is occasionally we may have a situation where we need to make a contract amendment or some adjustment that we'd need to bring an item back to the board. And in those events, if we did, we could call a special meeting and make the arrangements necessary to be able to bring that back.
But, Mr. Chair, we would still get monthly performance.
Yes, we'll make sure that we'll send out the monthly performance reports. Are there any questions? Can I take a motion?
Second.
All in favor? Any opposed? Last item that we have is to ratify the claims listings. Can I get a motion?
Question, just for my curiosity, who's ANCO consultant?
That is Doug Anderson. So it used to be Gregory W. Group, and now they've merged with ANCO.
Gotcha.
Yes.
We're not used to the name yet.
Yeah, that's right. We're adapting. They need T-shirts or something so everyone can remember, right?
I move that we pay them and everyone else on the claim committee.
Yes, that's right.
I'll second that motion.
All right. All in favor?
Aye.
Any opposed? All right. Thank you all. Next, are there any reports or comments from trustees, staff, or other interested parties? Any issues? All right. With no other items, then we are adjourned.